Hello and welcome back to Investor Info. Inflation, otherwise known as the silent thief, can often catch the finances of many individuals off guard, resulting in bad financial outcomes. In today's video, we'll be diving into how we can protect ourselves from inflation. But before we begin, please make sure that you hit that subscribe button and click on the bell icon so you'll get notified every time we upload a new video. You are not going to want to miss out. Now, let's get started. Horror stories about bread and milk prices spiraling out of control have cemented the image of inflation firmly in the popular psyche. These are reminiscent of the worst-case scenarios, such as the WEIMAR Republic, when shoppers were compelled to buy loaves of bread with wheelbarrows full of cash, and diners were obliged to pay for meals in advance since prices would have risen by the time they finished dining. At the height of the Weimar Republic crisis in 1923, monthly inflation reached about 29,500%, with prices doubling every 3.7 days. However, even today's 2% inflation rates will deplete the purchasing power of your bank balance faster than you would expect. In 1913, $500 could buy you a brand new Ford Model T runabout. Since then, the same $500 has lost 96% of its purchasing power due to inflation, leaving you with just enough money to cover the rent in a small town if you're lucky, much less buying a brand new automobile. Few individuals live long enough to witness such a drop in buying power, yet the effect of inflation is still extremely obvious even after 20 years. The US dollar has undergone an average annual inflation rate of 2.04% during the previous 2 decades. This may seem insignificant, yet it adds up to a mind-boggling 50%. So, in order to buy what would have been $100 in the year 2000, you would have had to pay $150 in 2020. Inflation has been even more dramatic in several European nations, with the UK averaging 2.8% between 2000 and 2020. And this is a pace that adds up to 70% over 2 decades. So, this begs the question, how can you safeguard your assets against this silent thief? In the famous example of the Weimar Republic, currency depreciation resulted in residents throwing worthless banknotes into drains and returning to a barter economy in which commodities and services were exchanged directly. The government finally reinstated the gold standard and the economy steadied. But the wounds left behind eventually contributed to the development of the Third Reich. If you had kept gold instead of currency throughout the upheaval, you would have not only survived, but you would have grown immensely wealthy in comparison to your cash-holding neighbors. But although gold would have safeguarded you against hyperinflation, would it now protect you from the silent thief of today's lower inflation rates? The United States has had many brief episodes of deflation, but in general, economic development is accompanied with inflationary pressures. Inflation may occur when there is too much money in the economy, causing the price of products to rise. Of course, if a household's 2 key sources of wealth creation, which are assets and income appreciation, increase at or above the rate of inflation, the negative consequences of inflation are offset. But, as we've seen time and time again, that's not always the case. While the minimum wage has risen, the overall cost of products has risen faster than average income growth in recent years. Inflation is sometimes referred to as the worst tax, since most people are unaware of its impacts. Hypothetically, earning 4% in a savings account when inflation is 7% makes many people feel 4% richer. They are, in reality, 3% poorer. That is why it is critical for both consumers and investors to understand the causes and impacts of inflation, as well as how to prepare to guarantee that their assets retain their buying power. Although less spectacular than a stock market disaster, inflation may be even more damaging to your assets. You should start investing in stocks right away. Despite most people's lack of faith in stocks, holding some equities can be a very smart method to prevent inflation. Consider your household to be a company. If a corporation cannot appropriately invest its money in initiatives that will provide a return that exceeds its expenditures, it will become a victim of inflation. The fundamental concept of business success is that firms would sell their goods at higher prices, resulting in higher revenues, earnings, and eventually stock prices. Some of the finest stocks to invest in during an inflationary moment would be in firms that can naturally raise their pricing during an inflationary period. One example is commodity resource corporations. During periods of inflation, commodities such as oil, wheat, and metals enjoy price power. In contrast to the price of a computer, which is subject to manufacturer and distributor pricing modifications, the cost of these things tend to rise. Price rises, however, are insufficient to defend against inflation. If a company's expenditures rise, price increases alone will not suffice to preserve equity appreciation. As a result, grocery stores which may gain from higher food prices may also suffer from a higher cost of items sold. Invest in businesses with the highest profit margins and, in general, the lowest cost of production, such as commodity enterprises or healthcare companies. Finally, never underestimate the usefulness of dividends during inflationary years. Dividends boost a portfolio's total return, after all. It also needs to be known that real estate is usually an excellent investment when done for the correct reasons, such as purchasing a home to live in. When a buyer's purpose is to profitably resell the property they just purchased, problems arise. Although expert real estate investors can uncover hidden treasures in houses, the typical individual should focus on buying a property with the intention of owning it for a few years, even if just for a few months. Real estate investments often do not yield a return within a few months or weeks. Instead, they need a long waiting time for prices to rise. As a house buyer, unless you pay cash, you'll most likely put some money down and take out a loan, known as a mortgage, to cover the rest of the buying price. There are other sorts of mortgages, the most prevalent of which are fixed rate and adjustable rate mortgages, but the essential idea is the same. You pay down a portion of the principal each month until you have ownership of a debt-free asset that should appreciate over time. If you have a fixed mortgage rate, you'll wind up paying off future debt with less expensive currency if interest rates rise. However, even if interest rates fall, you will still be liable for the set sum. Several variables should be considered while deciding on the best mortgage choice for you. Home prices, like land prices, tend to rise in value on an annual basis. True, real estate booms are frequently followed by corrective periods in which properties lose more than half of their value. Nonetheless, property prices tend to rise over time, offsetting the impacts of inflation. However, the best investment you can make to prepare for an uncertain financial future is by far investment in yourself, one that will boost your earning potential in the future. This investment begins with a high-quality education and continues with skill maintenance and the acquisition of new talents that will be in high demand in the not-too-distant future. Being able to keep up with a company's shifting demands may assist you to not just inflation-proof your income, but also recession-proof your career. The rate of inflation in an economy varies according to current circumstances. Inflation is caused by two factors: rising salaries and fast rises in basic resources such as oil. In the market economy, inflation is a natural phenomenon. There are several strategies to protect against inflation. A prudent investor may plan for inflation by investing in asset types that outperform the market during inflationary periods. Keeping inflation-hedged asset classes on your radar, and then acting when you notice inflation taking shape in a true organic growing economy will help your portfolio thrive when inflation arrives. I briefly mentioned gold earlier in the video, so let's talk a little bit more about how gold relates to inflation. Gold has long been seen as a safe haven against inflation. Indeed, many individuals have looked to gold as an alternative currency, especially in nations where the local currency is losing value. When their own currency fails, these countries prefer to rely on gold or other strong currencies. Gold is a genuine, tangible asset that, for the most part, holds its worth. Gold, on the other hand, is not a truly ideal hedge against inflation. When inflation rises, central banks' interest rates tend to rise as a part of monetary policy. Owning an asset that pays no returns, such as gold, is not as valuable as holding an asset that does, especially when interest rates are higher, implying greater yields. When it comes to protecting yourself against inflation, there are better things to invest in. However, diversity is essential in any healthy portfolio. If you are contemplating investing in gold, the SPDR Gold Shares ETF is a great choice. Ultimately, inflation is both deceptive and ineffective. It defrauds savers, defrauds lenders, raises taxes, and causes malinvestment. It does not eliminate unemployment, rather it reduces your pay. Inflation also does not encourage exports, but it does make foreign trading more dangerous. Inflation would be just dishonest if it were to succeed, but as history has shown, it never works. There is no evidence that inflation promotes exports or job creation. Consider this for a moment, however. Cryptocurrency is not influenced by inflation. And there you have it, folks. Now that we've discussed how to safeguard ourselves from inflation, let us know in the comment section down below how you plan to stay protected. Remember to always do your research and make the most of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video!